All right, Mr. Vineet Agarwal. Over to you, sir. Yes, sir.
Thank you. This is loud. This is louder. Okay, thanks. Yeah, I hope that this J is better than the other James. Yeah, and okay, bond the missing piece in your portfolio. But before we start about, I start about talking bonds. I would like to spend 2 minutes talking about the investment journey of any individual. So once we start earning, at least it was my journey, is that once you start earning, the first thing that you do is that you put your money in savings account or do an FD. Then basis any friend suggestion, you will start doing an SIP. You move ahead in your career, you earn more money. The first thing that you want to buy is a house for yourselves. That's a typical Indian dream that we have, all of us have. And in process, you will be buying gold for family members, etc. But what happens in this entire process is that once we earn more, we again tend to repeat the process. And during my previous experience before starting Jiraaf, when I work with a lot of large family offices in the country, I work with a lot of ultra HNIs in the country, what I saw is that they don't typically invest like us. In fact, a majority, in some cases up to 40-50% of their portfolio was in fixed income asset class, because they really understood the power of fixed income. They understood the power of having a regular cash flow in your life, okay? And they understood the power of predictability. And this is the missing piece which today is there in a retail portfolio perspective. It's a new asset class for last few years, since 4 years since we started this company. But in last few years, now this asset class has started getting prominence. And what you will see is that, in next 5 to 7 years, this will become part of everyone's portfolio like what mutual fund is today. So a little bit about ourselves. Jiraaf is basically a SEBI-registered entity. We are democratizing the access for bond for every individual in the country. Today, in less than 4 years, we have close to now 2.5 lakh investors on our platform and who have trusted us with over 8,000 crore of investment through the platform. Next slide. Now, what is a bond? A bond is basically a fixed income instrument which basically promises you a fixed return over a fixed tenor of time. I can go to the next slide. Now, I'll spend 2 minutes in this slide. Actually, Mint had asked us that if you can deep dive into what bond is so that people can really understand. So we have prepared a slightly technical slide for all of you, and I will try and simplify it as much as I can. So this slide, what it shows is that, a risk-return matrix of all the investment products that is available today in India. At the lowest end, you have FDs, which is the least riskiest product for an investor, but you also get the least return. It often doesn't beat inflation as well, but obviously it is the safest, which gives you somewhere between 5 to 7% kind of a return. Once you move ahead of the curve, then you have equities, which generally tends to give you anywhere between maybe a 13 to 15% kind of a return. And beyond that, you have angel investing and cryptos of the world. But the missing piece was any product which can give you, say, 7% or 8% to 12 to 13% return. The only product that can give you a consistent return is basically bonds. And you have different types of bonds. Okay, you have short-tenured bonds, you will have long-tenured bonds. We'll speak about that in the later half of the slide. But this is the missing piece in everyone's portfolio. If you want to earn anywhere between, say, an 8% to a 14-15% kind of a return, then bond is that asset class for you. Next slide. So how do bond work? Let us take an example of any company. For the namesake, let's use the name of Tata, for example. Now, if Tata wants to raise loan from public, there are only 2 ways that they could have done. Either they go to financial institutions like banks or NBFCs, and the second way is that they raise this money from public. Like you can buy a share of Tata, you become an equity owner in the company. Similarly, a bond is a paper which is issued by the company, wherein they take a loan from individual. You can basically give a loan to the likes of Tata by buying a bond from them. Now, what does it capture? It captures the rate of interest. The bond paper that you hold in your demat account like a share will capture the rate of interest. It will capture the tenor. It will capture the repayment schedule, whether it is monthly interest, whether it is quarterly interest, etc. And the security that they provide against this bond. So all the individuals, they subscribe to the bond issued either by the government or by companies. and they provide capital to that particular company, and they get the bond in their demat account. So this is how bond as a concept works. Now, why do we invest in bond? As I said, one of the biggest reason why people and the family offices and ultra HNIs have been investing in bond, the first is a steady and predictable returns. So now, let me give you an example. If today, as an individual, if I'm earning, say, 2 lakh rupees as a salary every month, and I need to add a 20,000 or a 30,000 rupees income onto my family every month, then the best way that you can do is, you start investing in all of these asset class, make a portfolio which will give, say, 11%, 10 to 11% kind of a return. On a monthly basis, you are getting this additional cash flows. Our ancestors, our parents, what they used to do for this additional cash flows was they used to buy commercial assets, right? That I will get monthly rental. It will give my family an additional income. So this was, but for that you need large corpus. But slowly and steadily, even with a small 10,000 rupees today, you can start building your bond portfolio. The second is goal-based investment. Now, what do I mean by goal-based investment? So suppose if you plan to buy a car, say 2 years down the line, and you want to start accumulating capital for that. The traditional method for doing that was keeping money in FD, but you are losing out on inflation. The other method is you can invest in equities, but the problem is that in a shorter horizon, which is in 2 years or 3 years, it's very difficult to predict whether the equity market will be lower or will be higher. In a 10-year horizon, if you have a 10-year horizon, then equity is very good asset class. You should definitely put your money in equity. But if for a shorter horizon, which is less than 3 years, 4 years, equity might not give you the answer. So the best way will be to start accumulating in this bond, because you will get regular cash flows, there will be capital preservation, and then you can meet your goal without losing capital. So a goal-based investment is another reason why people do invest in bonds. Third is portfolio diversification. In this, we have compared equity and fixed income as an asset class, but I generally don't like comparing because both has to be part of your portfolio. Okay, but just to help you understand more about fixed income, if you take the factor of volatility, so share market has volatility, fixed income by its very name, you can understand that there is no volatility in fixed income. It is not market linked. The returns are not market linked. Now the investment horizon. So generally, as I said, for equity, your investment horizon has to be long. You should be invested in equity market for at least 7 to 10 years. Then the probability that you will make money is very, very high. But for short term, it might not solve all of your problem. So fixed incomes become very, very powerful as a short-term investment product. Now from a return perspective, Nifty over last 10, 15 years, you take any benchmark, generally gives anywhere between maybe a 12 to 14% kind of a return. You can make a very, very healthy bond portfolio as well, giving the same returns, which is not market linked and short-term in nature. And it is a very, very globally accepted investment strategy. And people in India have already started warming up to this idea as well. Next, please. The last is to improve the overall portfolio return. What we have tried to do here is just give you a framework of how you should think from a portfolio perspective. You can put the total slide, please. Yeah. So if, say, for example, you have a total investable corpus of 100 rupees, you should have 20 rupees in your risk-free corpus, which can be the life insurance, the emergency liquidity that you need, etc. And the 80% should be your growth corpus for the life. Within that 80% of growth corpus, 70% can go into equities, which are generally longer tenured in nature, which can be, again, equities, if you have more money, real estate, etc. But at least 30% of your corpus from the growth should go into the fixed income in nature, which is generally less than 5 years. It can be in the form of bonds, SDIs, high-rated FDs, etc. Now the types of bond, there are multiple types of bond, as you can see. On the left-hand side is the bond that is issued by the government of India. It is the T-bill and the G-secs of the world. Here, typically, the return that you get is anywhere between 6 to 7%. And as you go in terms of rating, so a AA-rated bond today can fetch you anywhere 9%. Now, AA-rated companies, you will have many companies from the Tatas of the world, the Adanis of the world, which can give you 9% return, obviously better than FD returns, and then A-rated and triple B-rated companies. Obviously, we will never suggest retail investors to go beyond triple B. These are for very sophisticated investors. Yeah. Now, the risk of investing in bond, there are three predominantly defined risk of investing in bond. One is a default risk. That is when can you lose money is the question, right? The only way you can lose money is when the company goes bankrupt. Because the bonds, typically most of the bonds you will find are generally secured bonds. That is which we will also suggest you should invest in secured bonds. The probability of default for a secured bond, well-rated secured bond, is very, very low in India historically. You will obviously have exceptions, but like a 99% probability that you will not lose your capital unless the company goes bankrupt. The second is liquidity risk. As I said, it's a new product today in India from a retail participation perspective. Hence, the liquidity is low. Generally, it is a hold to maturity product. But SEBI and platform like us, we are working very actively to provide this liquidity feature as well. Very soon, in maybe next 2 to 3 months, all the bonds will start getting very liquid in India as well. The third is interest rate risk. But most of the bonds that typically investors invest are generally fixed in nature. So the interest rate risk is very low, and because of the tenor as well. So, and as you can see on the right-hand side, for the last 10 years, CRISIL has done a study. Any AAA rated bond, there is a 0% default. Any AA rated bond, there is a 0.3% default. And A rated bond has a 0.69% default. So the default rate is very, very low. Now, what type of a risk profile then investors should have? Like you have in equity, you have a blue chip company, you have a mid cap, you have small cap. Similarly, in bond also, you have AAA rated bond, AA rated bond, and triple B rated bonds. So based on your own risk profile, if you're very, very conservative and capital preservation is your strategy, then you should invest in government bonds. If balanced growth is your strategy, which is medium risk profile, then you can invest in AA, A-rated or a triple B-rated bond. And if you like taking risk, then you can go down further. But from a retail investor perspective, I would request not to go on that side. Yeah. Now, how do you invest using a platform like us? We are a completely digital platform. We can have the next slide, please. Yeah. We are a completely digital platform. We have been in this business for last 4 years. We have already seen these numbers. Can we move to the next slide? Yeah. So what we are trying to show here is that for equity, you had a lot of tools to help you take decision. We are the first platform again in India, in fact, one of the first, not only platform company who have launched our own bond analyzer. So there was no tool in India to analyze all the past issuance of the bond. If you want to compare two bonds, like you can compare two shares. If you want to compare the pricing of a bond vis-a-vis the pricing of government securities, there was no tool available. Now, today in our platform, you have these tools which you can use to make informed decision. We have also layered AI. You can come and chat, ask whatever questions that you have on your mind with respect to bond. We have trained it over last 2 years to help you take those decisions of making a portfolio and doing an investment in bonds. We are obviously available. Help you understand what bond is and how it is the missing piece in your portfolio. Thank you.
Anybody has a question they want to ask him right now? Yes? Okay.
Hello, sir. My name is Indrajit. You told that you got a B and C type bond. Like when we lose the money in B and C type, like government pay the money or we totally lost the money in that bond?
Just one clarification. We don't have B and C bonds, first point.
No, you have.
I said there are bonds which might be rated B and C. And as I said, I think twice, I will never request a retail investor to invest in those bonds. It is only for very, very sophisticated investor. And like any investment in world, whether it is real estate, whether it is gold, whether you buy share, whether you buy mutual fund, the risk is always taken by the investor. The only a bond which is insured by Government of India is the one which is issued by Government of India or the subsidiaries of Government of India, which are sovereign rated bond. That is which is 100% guaranteed or sovereign protected.
Then we will lose all the money or some money, like it will.
Sir, if the company goes bankrupt and if they have not paid anything in that case, so just I'll elaborate on that example. Suppose if the bond was for 2 years and it was a quarterly payment and you have already received your payment for 1 year and then the company went bankrupt, that is the only scenario you would lose 50% of the money because 50% you have already received, right? So sir, interest is like a regular income for you, and like whatever tax slab that you fall into will be taxed. Yeah.
Sir?
Yeah.
Okay.
Sorry.
Hi, sir. So here it is written, in the name it is written 8 to 15% returns.
Yeah.
In the app, it is showing highest in bond section up to 13.65%.
Yeah.
Which is up to.
Yes.
So 12, 13%, Win12 app is also providing. So
Yeah.
what different is Jiraaf doing?
No, there are 2 or 3 nuances. Like you get shares in Grow and Zerodha. Both are providing shares. It is the user experience that you have. That is point number 1. Most of the bonds you will find in, there are 3-4 other platforms as well where you can find bonds. But what different that we have done is that, as I showed, a bond analyzer. We are the first company in India to launch bond analyzer, which will help you understand bond. Now the AI layer on the bond, again as a user today, if you have to understand more, what the traditionally any other company, you will have to call them, you will have to talk to the RM and all of those things. But through AI, you can ask any questions about any other bond, which has been trained in our model. So these are the, from a user perspective, there are a lot of user interface, lot of technological, enablements that we have provided for users, which you can use to make a better decision. Lock-in period, so sir, it is like, as I said, it is hold to maturity generally. Yeah. There is no lock-in. You will get your, like, depending on the bond, you will get your monthly, quarterly payment, whichever bond you have chosen. It is like that, sir. Yeah. Yeah, we do have it. That is what I said. If you have any other questions, we do have a lot of people from our team. Please, you can visit that and ask as many questions that you have. Thank you.